What's up, you guys? It's Carmine. Wanted to hop on here and do a quick video on how to profit from demand imbalances, what to look out for, why they form, and kind of the backbone, the mechanics behind it with supply and demand trading. Obviously, I go more in depth in my course, but I wanted to just get a brief little introduction for you all because I'm getting a lot of questions about it. Before we do begin, if you want a good trading resource, I'm going to link my Instagram in the description below. I post daily trading recaps and very good trading tips and tricks. The link to this will be in the description below. And without further ado, let's get right into the video. Here we have four stocks on Wednesday, December 23rd, 2020. We have Beyond on the top left, Tesla, AMD, and Amazon. And each has a different story, but the backbone, the mechanics behind each imbalance is the same because obviously supply and demand is how the market moves. It's the only way price can change. If you have imbalances, what that basically means is that the market is too stacked on one side of the market and price is going to either increase for demand or decrease at supply. It's economics 101, it's supply and demand. So when we're talking about an imbalance, the market moved too far away from an area fast, aggressive, and violently that there is going to be an order imbalance sitting at that area or sitting at that zone, waiting for price to come back, test that imbalance, and pick up more orders that the next time it tests it. If we're talking about demand, which this video is about, not really supply, but if supply outweighs demand inside of a demand zone, then obviously that demand zone is not going to work out. These zones are very good magnets to price. They do not guarantee that price is going to bounce. They are just high probability areas of where the market could possibly bounce with very low risk. So here we have Amazon and we have one demand imbalance at the top and then we have another imbalance at the bottom. Obviously it took a little while and we bounced at the bottom one and we invalidated this top one. But that's going to beside the point. But the whole backbone to this is think about it like you're at a pizzeria again. You got 10 people waiting in line. It's the best pizza in town. There is only, 10 slices left. They're cooking more, but the first 10 people are going to pay $2 per slice. And now you have the 10 buyers buying 10 slices of pizza from the seller, which is the pizzeria. So now we walk in line, we're the 15th in line, and now there's no pizza left. We can't buy nothing. So what we have to do is now we're waiting in line and the market is an auction process. So for us to get a pizza right now, what are we going to have to do? We might have to pay a little more premium. Maybe we can't get a plain slice. Maybe we have to get a gourmet slice. So either we wait, we pay a premium and price will go up because the demand moved away. There's no more supply. Price came up. Or we wait for the market to come back down. We wait for the pizzeria to create, 10 more plain slices. And then we could buy at $2 instead of paying a premium at a higher price. That's, as short as possible as I could explain the demand imbalances and supply imbalances. Obviously go more in depth in the course. But we wait for price to retest the demand zone. And then we can look to place a trade as long as there's confirmation from buyers or sellers, because these areas are going to be high probability zones where the market could possibly turn. So this demand zone is formed before price is traded, So every time price comes into the zone, it gives us a good buying opportunity. Now, when the market is all about context, it's all about reading what it's telling you. So just because we are in demand, it does not mean to, buy, or if we're in supply, it does not mean to short. You have to understand the bigger picture. You have to understand volume. You have to understand context, and you have to understand price. Are we in an uptrend? How is the higher time frame looking? Are we making higher lows, lower highs? Have we bounced off of demand before? Is demand used zones acting as support? There's a whole, laundry list of stuff that we could go over. Obviously, I want to make this video as brief as possible, but here we have Beyond, and if we're looking at a trading setup, and this kind of goes into how retail traders, this is my edge. If you don't understand supply and demand, in my opinion, you're buying and selling blindly on a stock chart. Yeah, you could have indicators, you could have other things that, paint the story to you, which you have tested, which is proven to work to you. But in my opinion, this is what works for me. This is my edge. And I don't trade how normal retail traders trade. I don't have indicators. They work. You could use indicators confluent with supply and demand. anything that's giving you indication that buyers and sellers are present in the market, then go for it. Add it to your chart, make it confluent with supply and demand. It could be very, very powerful. For me, it's just price and volume, because I've been trading for 5+ years now, and I can understand the context of the market. I see certain things. I recognize different patterns because I've been trading every single day for 5 years. So without rambling too much, let's get into Beyond. So Beyond sold off, and if you're looking at it from a pure technical standpoint, it looks like it's the end of the world. Let me just zoom out. The market's selling off. If we didn't see this lower wick, we opened at 139-ish and sold off to almost 137, 136.50. Market looks like it's tanking. We have heavy volume, but if you don't understand we're in a demand imbalance, there's no reason to get short. We have a lower wick. We have heavy volume coming through, buying pressure coming through. A wick validates it. We come above. We're holding above the demand zone, and then this thing started ripping. Now, in a perfect world, we're going to move from supply to demand. I can make a follow-up video on supply, but in a perfect world, we're going to go from demand to supply. Maybe it happens 8 out of 10 times that it doesn't. 2 out of the 10 it does. But an ideal target would be supply. I always scale out along the way up just to protect myself, because right now with the market, it's been very choppy. But this was Beyond heavy volume. So a lot of people see heavy volume and they do not read it in context. They see heavy volume, they think heavy volume below a key level or below a major psychological level. They think they're going to short the market if it's coming down. If there's heavy volume and price cannot continue to go lower, that is a sign of absorption, and especially that we're in demand, because you have these buy orders that are sitting at this area since the imbalance was formed, waiting to get filled. Now price comes into there. You have sellers active in the market, hence the heavy volume. There's a buyer for every seller and a seller for every buyer. There's 4 participants, two active and 2 passive. But for every transaction, there's a passive and an aggressive participant. So the heaviest volume, if not used in the proper context, is going to be very misleading. Heavy volume with follow-through is a sign of continuation, but heavy volume without follow-through, as we see here, we see with the lower wick, is absorption. And in this case, we're talking about buyers propping the stock up at demand. There's examples all day long, every day. Some work, some don't work. But each of the times it gives us low risk and we get in with proper confirmation. Tesla, the same thing. We had a lower wick here, very strong green buying pressure, and the price started to rally. We came up, and here's what I want to mention here. Heavy volume coming through here, but no follow through. This is telling me buyers are getting exhausted. So you see this right here, and then the volume down here. It's one of the heaviest volume bars, the most volume throughout the day, and price cannot continue going higher. That is a sign that buyers are getting exhausted. And hey, maybe not focus on the long, maybe get long on a pullback, but I'm not going to buy a continuation play to the upside because buyers aren't getting very strong here. They cannot continue it to the upside. We broke above 650. 650 is a huge key psychological level. Broke above it briefly and immediately failed. So it's just about market psychology, seeing who you are up against, who are the participants, and just trying to outsmart the competition. And then Tesla did nothing for the rest of the day. Amazon. Now, this is a very good lesson. So we've been forming a very decent looking wedge the past couple of days. And obviously, today we broke out of it. But yesterday, it was getting tighter and tighter. We were making lower highs, higher lows. So getting super, super tight. I saw people all over the place. I saw it in my Discord room, people looking for the breakout above the trend line. I saw it on Twitter. I saw it from just, other people in the trading community. You have to understand that if everybody's doing it, it is not going to work out. So here we have demand, which Amazon bounced off of, 1 time, 2 times. And we have this zone, which was created from this consolidation period yesterday, which, we failed, we broke below. But we came into the zone, heavy buying pressure. We see wicks right here and we bounce. Now this is at the time that we're stalling right at this wedge. We're getting super tight. We come down, we test the wedge again. We bounce from it. Looks like it's a perfect world. And whatever way we break out is where we're going to continue. If you don't use it in context, it's not going to work out. We broke above, look at this heavy volume. Heavy volume down here, failed to follow through. Heavy volume up here with very strong buying. You have to think of all the breakout traders that are seeing we're breaking out of this wedge. What's going to happen? Everyone's long on the market. If everybody's buying, there's nobody else is going to be able to buy it. And what's going to happen to price? It's going to come down. And that's what we did. We broke out of this wedge. Nice bounce from demand. Broke out and then sold off the rest of the day. And then today, we did nothing. There's no really trade right here. The more times the level gets used, the weaker it becomes and the less significance I give it to the zone. As soon as we break below it, I invalidate it. AMD, this is also a good one. So this was forming. Every time we come into demand, we bounce. We double bottomed on Wednesday. Nice long entry right here. You could get a quick, $1.50 from it. But we were making a inverse head and shoulders pattern. So you're not really going to see it too well from this. But we have a left shoulder, we have a head, and then we have a right shoulder right here. So you have to understand, watch these things form in real time. And that's when you're going to get the best picture and the best idea. Left shoulder, head, and then bottom right shoulder. So there's setups every day. The key is finding them. The key is understanding the mechanics behind the market. And the key is reading context. The market is not the same every day, even though it looks the same because the candles are going to be the same. The market is always telling you a different story. For you to be successful, for you to be profitable, you have to be able to read it. So I hope this wasn't me just rambling on again. I tend to do that on these videos, but I just wanted to get this point across. I hope you enjoyed this. One thing I want to mention is that the courses are going to be discounted for the rest of the year. And then starting January 1st, there will be a refresh. I'm going to upload over 10 new videos to the course. Obviously, current members are going to get them. And then the prices are going to increase as I add more content and more value for my members. So just a heads up on that. And I hope you all enjoyed this, and I'll see you all next week.